Valutrades.
Good morning, good afternoon, good evening, wherever you happen to be, and welcome to the Valutrades webinar on quantitative easing and how traders can benefit. The title of this webinar was Understanding Quantitative Easing and its effects on the Forex markets, its effects on the gold market, the metal market, the stock market, the Forex market, whatever. We're going to go through all that this evening, and hopefully you'll make you better traders by understanding how the central banks work, what they're doing with quantitative easing and quantitative tightening. We'll talk about that, and how you can benefit as a trader. My name is Brad Alexander, and welcome to the webinar. Excuse me, need to get the slides going. Here we go. I've been working with Valutrades for a number of years now. I'm a trader, retail, and professional, and my job day to day is to provide content for the financial services market. Most of my work is done for Valutrades, I'm proud to say. You may have seen my videos Mondays and Tuesdays. It's an important topic right now because the difference between the Monday video and the Tuesday video is fundamental versus technical analysis. And quantitative easing is all about fundamental analysis, nothing more, nothing less. So we'll go through all that as we get through the webinar to explain what we're talking about. I work with brokers, educators, fintech companies. I do consulting with other brokers for bank accounts and licensing, which is a challenge these days. And I'm nicely placed with a lot of great colleagues that I work with to help other people to get involved in hedge funds and so forth. But today I'm going to be an educator. I want to get you familiar with how the central banks work with quantitative easing and how you can benefit from that. Before we get going, we need to look at our disclaimer. If you don't understand the risks involved with trading, please drop on the Valutrades chat line and ask them, or you can look at the website. There's a set of disclaimers there, because CFDs and Forex are leverage products and your capital may be at risk. If you don't understand leverage, we've got videos on leverage. I've done them, so take a look. So please understand the risks before you start investing any serious money into Forex trading. We want you to make some money at this. Right, so what are we going to be talking about this evening? Again, quantitative easing is about fundamental analysis, nothing more, nothing less. And you may say, people say, well, how boring, I just want to trade, I just want to look at the charts and get my buy and sell and set my stop loss and walk away. Well, I know a lot of traders who trade purely on the technicals, and they end up asking me a lot of questions about the fundamentals, because the fundamentals, as far as I'm concerned, are the place to start when you're selecting your strategy and you're deciding what to trade that day or that week. Fundamentals are clearly important. And if you don't know, if you're a new trader, the difference between fundamental analysis and technical analysis, fundamental analysis is based on making decisions based on what happens in the news with economic events. Technical analysis is all about those wonderful charts, indicators, and price action. I definitely start with fundamental before I make any decisions on trading. So what is quantitative easing? We'll go through the definition of that in a minute. But just as importantly, what is quantitative tightening? Well, as the name would suggest, it's the exact opposite of quantitative easing. And I'm going to be explaining to you why a central bank would do one without the other or with the other, and when would they switch over from one to the other. And we're in a situation right now where that has just happened. We've had years of quantitative easing, and now we're going into quantitative tightening to try and fight inflation. And I'm going through all the socioeconomic reasons for all that in a minute. Right, and once you understand what they are, we're going to talk about how to trade them. And the way you trade them is it's not simple at all, but it's the same way you trade any news event. And I'm going to be showing you about halfway through. Typically, I'd wait till the end of the webinar to show you how to trade something, but I'm going to be nice this time, and I'm going to look at it about halfway through. If you have any questions on anything I say, just pop on the chat line on the question and answer on your webinar. I'm happy to answer as we go along. Okay, right, the role of central banks. Well, central banks are all about fundamental analysis. Their job right now, central bank, doesn't matter where you are in the world, the United States is the Federal Reserve, the Bank of Canada, Bank of England, European Central Bank. Right now, their job is to control inflation. That is the big problem in the planet right now. Why do we have lots of inflation? Well, we could start with Donald Trump, which led into a pandemic, which led into Vladimir Putin, which led into an energy crisis. logistics problems based on the pandemic. I could go on and on and on. Right now, we have a very, very serious problem with inflation. And spoiler alert, this is when the central banks change from quantitative easing into quantitative tightening. And I'll explain what that means in a second. Okay, I want to talk, I'll go through a glossary of terms near the end of the webinar, because if you're like I am, you watch Bloomberg, and if you're watching the business news, they throw a lot of jargon at you. And any industry has this jargon. I don't care if you're in finance or you're a plumber or you're a carpenter. We all have our jargon in our industries, and we are, as in financial services and retail and professional trading, the central banks, chock-a-block full of jargon. So I'm going to explain a few terms to you so you'll be able to sound intelligent, or at least think you're intelligent when you're listening to Bloomberg next time. And fiscal versus monetary policy is key to understanding the way government and central banks try to fight inflation, help employment, and so forth. And I'll go through that near the end of the webinar. And as I've alluded to already, there are central banks around the world all trying to do the same thing. What's unique about the situation we have right now is that almost all central banks have individual problems. The European Union right now is on the verge of an energy crisis. The Americans have labor issues. The Japanese central bank has the biggest problem. They had the exact opposite of everybody else. They were in a deflation. They were trying to fight deflation, while the rest of the world was trying to fight inflation. So they are sort of behind the 8 ball, and the reason the yen has been so weak the last few months is because of the differential between the bond rates and the interest rates between the Americans and the Japanese. And it's been very, very difficult to fix. Now the Japanese yen is getting stronger because they have injected some cash into the system. They bought their own bonds. So we're going to be going through that as we go through the webinar. And what to look for in the future. And basically that's one of the jargon words. It's called pivot. I'm going to explain what a pivot is near the end. So when the central banks are heavily into quantitative easing and they pivot, they go into quantitative tightening. Now we're in a situation where we're in quantitative tightening, and the market is wondering when we're going to go back, because they like it a lot. The bond guys love it now. The interest rates are going up, bond yields are going up. They were in limbo for almost many years because the bond market was quite boring. Now it's much more interesting. And I want to talk as well about fundamental analysis. A lot of people will say, well, we're talking about central banks, we're talking about quantitative easing. How boring can that be? Well, if you're going to be a successful trader, you really, really need to understand these things and really get a handle on what the central banks are doing and what they're trying to do, because they're very often driving the markets. And if you understand how they're driving the markets and how much they drive the markets, you can put in place your technical analysis and make those trades. And I'm going to show you that at the end, near the middle and end of the video of the webinar. Okay, let's look specifically at quantitative easing. Okay, so what is it? Here's a nice little paragraph I stole off the internet, and I'll read it to you. To execute quantitative easing, central banks buy government bonds and other securities, injecting bank reserves into the economy. Increasing the supply of money lowers interest rates further and provides liquidity to the banking system, allowing banks to lend with easier terms. Okay, what's important here is that the quantitative easing does lower interest rates. That's not to say the central bank doesn't lower interest rates, because they do. That's one of their two jobs. They have basically the central banks, and here's a picture of Jerome Powell, who is the chairman of the American Fed, the US Federal Reserve. You need to get to know him. They can raise and lower interest rates, which they're doing right now. They're raising quite a bit. But as an added bonus, they can do, when they were lowering interest rates, I should say, they were doing quantitative easing, which helps interest rates even further, lowers them. Right now, we don't want that because we have a high inflation. So what this paragraph means is that if there's a lot of liquidity in the market, then it's easier for the banks to lend with lower interest rates. And because there's a lot of competition for lending, the interest rates come down even further. So notwithstanding the bank rate, which has been set by Jerome Powell and other central banks around the world, when you have quantitative easing and a lot of money being injected into the system, you have competition for lending, therefore the interest rates at the bank level to you buying a car or a home come down. We're getting away from that now because we have a serious problem with inflation. So they're doing it the other way around. Okay, it's not about printing money. Many people thought, okay, quantitative easing is just about printing money and chucking it into the system. That's not quite the way it works. A lot of people say, well, quantitative easing is similar, is like effectively about printing money, but it's technically not. You can't just print a lot of money and then go to the street and hand it out. That's not the way it works, or give it to the banks. You still have checks and balances, and you still have a balance sheet to take care of. So the way it works is that the central banks will actually go out with their money and they'll buy government bonds and other securities, usually mortgage-backed securities. No matter what you saw in the film The Big Short, they're buying mortgage-backed securities, hopefully a little better this time. So what they're doing, they're actually exchanging, they're replacing those bonds that are with the banks and the bondholders and securities with cash. So it's a transaction. So basically the central banks pick up the bonds, which will pay a yield and they have value, and securities, which could be assets, equities, could be mortgage-backed securities. So they're exchanging their cash for these assets. So if you go down to the shop and buy a bicycle, you're exchanging your cash for a bicycle, and the bicycle will serve you well, maybe sit in your shed for a while. And it's the same with the bonds that the central bank has. They may just sit in a vault for a while, or they may come to maturity, and the central bank then can cash them in, just like you or I would cash in a bond. They can do that as well. What's important to know about the central banks is the more they do quantitative easing, the amount of assets they have in their vaults and their warehouses gets higher and higher, and that could be another problem. So we're going to be looking at that in a second or two. Okay, so as we said, it stimulates the economy by encouraging lending. So I'm going to go back through these slides very quickly because these people, you really need to get to know. So we have here Jerome Powell, who is the chairman of the US Federal Reserve. Excuse me. Oh, I missed one, I'm sorry. We have Lyle Brainerd, who's the vice chair of the US Fed. Okay, so these two people are probably the most important financial people on the planet right now. You may not have heard of them, but I'm going to show you where you can listen to them and see what they're up to. Christine Lagarde is the president of the European Central Bank. The European Central Bank is the central bank for all of Europe. Obviously, different countries within Europe have their own central banks, but Christine is in charge of basically the whole lot, and she makes the decisions, and her team make the decisions on quantitative easing, quantitative tightening, and raising interest rates. Okay, Andrew Bailey is the chairman of the Bank of England. The Bank of England looks after the entirety of the UK, and they do the exact same thing. And again, every single these economies I just spoke about, the United States, Europe, England, I said the United Kingdom, they all have similar issues where they're trying to fight inflation, but they all have unique problems that they're trying to solve themselves. And in the past, usually central banks cooperating was a good thing to do because it got them moving. These days, it's not because they don't want to cooperate. It's because they all have individual problems that they're trying to solve. Okay, here we have Mr. Kuroda, who's the chairman of the Bank of Japan. And without sounding too disparaging, a lot of investors can't wait for him to retire next spring because his policies have really not worked out well in Japan. 0% interest rates and so forth have left them behind the 8 ball. And they're quite lucky now that the Japanese yen is starting to become a bit stronger, and I'll look at that in a few minutes. So there's some central bank heads that you really need to be paying attention to. Other important central banks are the Bank of Canada, the Reserve Bank of Australia, and the Reserve Bank of New Zealand. Those are the ones that really move the market. Believe it or not, the Reserve Bank of New Zealand is actually the number 50 bank in the world. There are a lot of banks ahead of them, like India and so forth, and Spain and Italy. But the drivers of the economy, of the Forex markets, are the ones that hold the currency, like the New Zealand dollar, Australian dollar, Canadian dollar, etc. And of course, as always, the biggest driver is Jerome Powell with the American dollar. And of course, you have the PBOC, which is the People's Bank of China. Well, obviously, the second largest economy in the world is going to be driving policy, but very often a lot of what comes out of the central bank of, the People's Bank of China isn't exactly accounted for. So you be very careful when you're following their data. Okay, quantitative tightening. Now we've talked about quantitative easing. What is quantitative tightening? Well, you've probably already figured out it's the opposite. So basically, the other word for it is balance sheet normalization. And when you have a lot of quantitative easing, you end up with a big balance sheet. And I'll explain what that is as we go along. It basically means that they're overloaded with bonds and securities. Right now, the U.S. Federal Reserve has over $8 trillion in stuff, in bonds and securities. And they're starting now to unwind it. That's another term that they use. They unwind it. So they're selling off these things, which is quantitative tightening. Or they also call it balance sheet normalization. What they're trying to do is the economy is running too hot. It's the inflation is too high, so they're trying to reel that in, along with raising interest rates. So typically, raising interest rates goes along with quantitative tightening. Lowering interest rates goes along with quantitative easing. Okay. So again, with tightening, the central banks sell bonds and other securities, or they slow down the rate of purchasing. They may continue to purchase them, but if they slow that down, they call that tapering. And the markets see that as a hawkish, and here's another term they'll throw around, hawkish and dovish. So quantitative tightening is hawkish and quantitative easing is dovish. Okay. If I'm chucking too much jargon at you, write these things down and Google it, because we could spend another webinar talking about jargon. So when the central banks slow down the rate of buying, it's also a form of tightening. When they sell them directly back to the market, it's also a tightening. Okay, and basically, as we've been saying, it's an attempt to lower inflation. And right now, inflation is the biggest problem that the central banks have around the world. And quickly, why do we have inflation? Well, we have a lot of supply chain problems based on the pandemic. We have an energy crisis and a war going on, thanks to our friend Vladimir Putin, and the timing could not be worse. Okay, here's an example. In 2008, we had this big old crash. If you don't know what that is, just watch the film The Big Short. It explains in vast detail, great detail, why the banking system and the global economies crashed in 2008. And if that's not enough for you, watch a film called Margin Call, which is basically it's disguised as the true story of Lehman Brothers. And in September to October of 2008, Lehman Brothers went out of business. The American government and governments around the world were bailing out the big banks and insurance companies because of the subprime mortgage crisis, which again, watch the film. And Lehman Brothers just simply could not be bailed out. They just done too many things that were wrong, and they didn't. So it had a massive market crash. So on this chart, we've got euro dollar going down, which meant the American dollar got very strong. So you're probably asking yourself, and I get asked this question all the time, in a crisis like that, why does the American dollar get so strong? Well, it's really simple, actually. We talked about how the central banks are buying bonds. They're putting money into the system, or when they sell bonds, they're taking money out of the system. Well, it's the same in a crash. The first thing to hit, the first thing to go are stocks and equities, and that investors will just sell off. They'll get scared, and they will sell off their shares in Apple or IBM or whatever they happen to hold, and they exchange those shares for cash. So when you suddenly have a demand for cash, and again, everything is supply and demand, there's a lack of demand for the stocks in a crash and a big demand for cash in a crash. So the American dollar gets stronger. So that's why this chart went down. And that was a big problem. If you look at other charts like dollar CAD or dollar Swiss, the chart was going up because the American dollar was getting so strong because of the sale of equities. Again, supply and demand. Investors panicked. They sold off their equities. They exchanged their equities. And what do they do it for? They do it for American dollars. So you didn't find this happening with other currencies because most of the stock market activity on the planet is done through New York. It's as simple as that. Most of the Forex market and metals is done through London. but when you're talking about equities, it's done through New York. So this was a case where they exchanged equities for cash, which is a very dramatic form of quantitative tightening, basically. So the reason I'm mentioning all this, at the bottom of this chart, we went through a series of literally years where the governments tried this wonderful experiment called quantitative easing, and they basically just did that. They bought their bonds and securities and chucked cash into the system, firstly to try and make the American dollar a little weaker and to stimulate the economy, because after the crash of 2008, the banks were devastated. Of course, when the banks get devastated, a lot of businesses get devastated. I had a small business in Spain, and I know for a fact that my phone stopped ringing the day Lehman Brothers went out of business. It was that simple. And I hung in there for 2009 with some high net worth clients, but the paranoia was too much, so we had to pack up and move back to London. And it was quite devastating for a few years in terms of watching different companies go out of business and different market sectors go out of business based on this crash. So the American government, the American Central Bank, the U.S. Federal Reserve, started quantitative easing for a period of 6 years. To this day, they can't say whether it worked or not, but many economists do believe that saved the economy, that quantitative easing. So we can say it was a success story, and that's why they're doing it now off and on. Okay, we've talked about quantitative easing, quantitative tightening. You get an idea now of what it is. So I'm going to, instead of waiting till the end of the webinar, I'm going to talk right now about how to trade it. And the way you trade this is basically the same way you trade any news event. You take a look at the trend of your favorite currency pair. And if you're smart, you will look at all the pairs in any given currency. So if you're looking at, you want to trade the US dollar, you look at euro dollar, you look at dollar CAD, dollar Swiss, Aussie dollar, or gold. And that's important to understand. XAU USD fits into the mix of US dollar currency pairs, and it's really critical because I've made some key trades when I couldn't find a trade based on dollar Swiss or euro dollar. My standby is XAU USD gold. So if you follow along, if you want to trade the dollar based on a news event, don't forget to look at gold, because gold is driven by the American dollar. So what you want to do, and I call it counter trend price action trade. What I want to see when I'm trading a news event or a speech by Jerome Powell or Christine Lagarde, I want to see them drive the price against the trend. And then I want to see, and that is what we call fundamental. That's a fundamental move by a central bank. And then what I want to do, I want to see price action crash into a technical element, whether it's a trend line or a line of resistance or a Bollinger Band or something. And then I will take the trade in the other direction with the trend. So I cannot tell you how well this has worked for me over the years. If you need to do this, though, you need to understand fundamental analysis. You need to understand what the central banks are doing, and that's what this webinar is all about. And you need to understand, basically, on the technical side, how to pick a trend and how to watch price action move against the trend until it hits a technical point, and then take the trade in the other direction with the trend. Always trade with the trend. So that's what I call my counter trend price action trade. Okay, and again, I'm going to repeat till you get bored of hearing it. Fundamental analysis is the place that I start when I'm trying to look for a trade, trying to look for a strategy or looking at a pair to trade. I call this my order of analysis. I have one student who actually made this into a poster and stuck it on his wall. And then I look for support and resistance. Then I look for chart patterns. And if you watch my technical videos on Tuesdays, you'll know I'm crazy about chart patterns. I don't stop talking about it. Then I look at indicators, and then I look at candle patterns. I look at candle patterns last because they're a convenience and they're a confirming tool. But the first four are key for me. I could see an amazing technical setup, but if I know that there's a news event coming up, or I know that, give you a good example. Here's a great example. I actually spend a lot of time with a professional trader. I see him every day, and he's one of the best traders I've ever met, and he's purely technical. I think today, literally including today, he's made about 25 trades in a row without a loss. His plan is to do nothing but trade once he retires. But he doesn't follow fundamentals, and very often I will tell him, look, don't take that trade because the fundamentals are not in your favor. Well, why? And I said, well, maybe there's a news event coming up today, or the Bank of Canada has just announced there's a rumor about the interest rate. Wait until the fundamentals are sorted out, then take that trade. And very often I've caught him, and he's actually I've kept him out of a couple of trades that would have gone wrong. The other day he wanted to go long on gold, and I said, no, that's not the way, not yet. In fact, he's now taken several shorts on gold in the last 3 days and made a lot of money off it. So luckily I caught him before he went in the wrong direction, because technically it made sense. Fundamentally it made no sense. So you need to understand what the central banks are doing, what the news events are all about before you start looking at support and resistance and chart patterns. Again, not that they're not important, they are critically important. Okay, the economic calendar. Again, if you're a new retail trader, you may find this, oh, that's too boring, I don't understand it. Well, there's two ways to look at this. If you want to trade news like I do, this is your Bible. You need to know this and follow it. And the one nice thing about trading news events is that you can actually schedule your trading times. You can trade before news events. If you don't trade news events, it's just as important to look at the economic calendar, because you can be thinking about going into a trade. In fact, I did catch my friend today. I said, be careful, because Andrew Bailey is going to be speaking today and you're looking at trading the pound. Wait till he's finished. And I actually finished the conversation because he said, well, there's really not many setups right now. And I said, yeah, because this week is the non-farm payrolls. And that very often happens. The market will sit back and wait for the non-farm payrolls to end and maybe pick up the week after. And that very often is the case. Very often you can't find a setup. It's probably because the rest of the world can't find a setup either. Very often the markets just get bored. They're waiting on something. They're waiting on Jerome Powell. They're waiting on the FOMC. They're waiting on the non-farm payrolls, whatever. And that's what's happening now. Right. In this particular case, I'm looking at because we're talking about quantitative easing and quantitative tightening. So the way the market looks at that, there's really no set event to say that, okay, we're going to be doing this now or whatever. But the way the market views this is they watch the central bank governors speaking and they wait for the statements. So here we have today, on this calendar, we have the Reserve Bank of Australia, Governor Lowe is going to speak. And that may sound boring, but the reason it's got a red dot beside it, a red square, is because it's a high impact event. These central bank governors, when they speak, they can actually drive the market far more than other events. And it's very important to understand this. And I'll give you an example. I was teaching a student about 2 years ago, a brand new trader, but very, very sharp technically. And I gave him some homework, and I said, look, I want you to watch. I was in London, and I was in Spain, I think, and he was in Florida. So he was in the New York time zone, which was handy. So I said, what I want you to do tonight, I want you to watch the charts when the Fed announces their new interest rate. It may go up, it may go down, it may stay the same, but I want you to watch the charts, see what happens on the 1 minute chart, maybe 5 minute chart. And then half an hour later, I want you to watch Jerome Powell speaking and watch the charts at the same time. Okay, so the next day we caught up and he said, wow. He said, I never knew that a speech could move the market so much. And I said, exactly, now you understand. And this is homework for you, anybody watching this webinar. Do that. Don't ignore these speeches on the economic calendar because they can drive the markets. Here we have Christine Lagarde. If you look at this calendar, she's actually speaking 3 times in 1 week. We've got Governor Bailey speaking on this event. We've got, again, Jerome Powell speaking here. We've got the Reserve Bank of Australia speaking again. Christine Lagarde again, and Christine Lagarde for the 3rd time. Again, I cannot emphasize enough, some homework, turn the charts on, watch when they speak, and you'll see what happens. And I can tell you honestly, the biggest trade I ever made in my life for my client and for myself as a professional trader was on the back of something Jerome Powell had said. I was trading the US interest rate announcement, and I traded it the way I just showed you, and I'll go into more detail in a minute. about how I traded that. And I was in profit very quickly, and the market was doing exactly what I expected it to do. And then half an hour later, Jerome Powell came on and basically contradicted everything the market had believed up to that date. And the currency pairs went crazy. And I very quickly closed, I don't know, a CAD yen trade I was in that wasn't doing anything. And I opened up several trades, Aussie dollar, dollar CAD, dollar Swiss. And I rode them until about 3 o'clock in the morning. I set my alarm 3 times to wake up and watch the charts. And I managed to close all those trades at the exact top of the market. And I made for our fund 3%. And that was based purely on a speech by a central bank governor. It's not easy, but you can do it too. Just pay attention and get some experience. 3% doesn't sound like very much, but when you're trading professionally for a fund, that's a fortune. This particular fund, our goal was 1% per month. I know if you're getting into retail trading and you hear about people tripling their accounts overnight, well, there's a reason for that. They're gambling. As a professional trader, if you're expected to make 1% per month, it's actually not that easy, but that's 12% per year. That's actually quite a good return if you're a hedge fund. Okay, right, here's some words to live by. And here's a picture of the FOMC, which is the Federal Open Market Commission. And these are the guys, including Jerome Powell and the various presidents of the Fed banks around the United States who make decisions on interest rates. So here we are, words to live by. The fundamental events drive the markets. I've said that. Technical events drive computers. Okay, what does that mean? Again, fundamental events drive the markets. I've just spent the last 45 minutes talking about that. Technical events drive computers. So basically what I'm saying is that these price action movements driven by the central banks will drive price action into a technical event, which will trigger a trade by a computer. If you don't believe me, just watch the charts. You'll find that price action will reverse on trend lines and Bollinger Bands and Fibonacci and so forth. I'm going to show you exactly what I'm talking about. So when you're setting up for a trade, and this is what I call my price counter trend price action trade, you can look at a chart. Here's a chart on pound Swiss, maybe not the chart you want to trade, but depending on who's talking, what news event is coming up, take a look at the chart, and I want you to determine where the trends are. In this particular case, you've got 2 trends. You've got a massive downtrend that's been going on literally for months. But lately, over the last, if I just look at the calendar, at the chart very quickly, it looks like about 2 months, you've got an uptrend. So you can actually trade this either way, which is very handy, but just be careful which trend you're following. So basically, and I want you to do this. I want you to do the usual stuff you would always do in any setup. You want you to plot your support and resistance. Those lines of support and resistance aren't just handy. They're not just there to pick the bottoms and tops of candles. They're there for a reason, and they represent round numbers, or they represent, again, the computer. The big banks and big hedge funds have programmed their machines, their computers, or told their traders to buy or sell at these levels, and that's why they're called support and resistance. So when price action is driven by a central bank announcement into a line of support or resistance, chances are it's going to trigger a lot of trades in the other direction. That's where you get in. Okay, so here, for example, let's say we had a news event on pound Swiss that drove price action into this blue square. That to me would be a trigger, a technical trigger based on a fundamental event. So I would not necessarily just go long on it. I'd want to wait until the spreads calm down and I got some confirmation from maybe another candle, and then look at going long again with the trend. If it broke through resistance, or broke through support, sorry, I might consider a different strategy. Okay, again, plot trend lines. Here, as I mentioned, this particular chart has 2 different trends, one long-term downtrend and one short-term uptrend. So you've got the best of both worlds. And you can look at other indicators like Fibonacci. We could spend hours talking about Fibonacci, and I have in the past. Just watch the Valutrades videos on Fibonacci to understand how that works. And again, if price action is driven by a fundamental event into a Fibonacci level like this blue square, that could be a great opportunity to take the trade in the opposite direction if it bounces. Okay, and what I do, I don't just follow one pair. If I'm trading, this is a selection of US dollar, the majors. I've got dollar Swiss, I've got dollar CAD, et cetera, et cetera. If I'm trading a news event, not every single pair is going to give me the right setup because the trends will be different. If you look at this particular chart, dollar CAD has gone crazy. There's something's happened to the Canadian dollar, which is not good, obviously. And I've got Australian dollar, American dollar, which is clearly in an uptrend. Dollar Swiss, which is clearly consolidating. So I need to watch where the trends are, which time frames are going to trade this on. If you're watching news events, you might want to trade on the 1 minute chart, but you need to determine where your trends are on a higher time frame, like 30 minute, 15 minute, 1 hour, 4 hour. And if the news event is very severe, it may just keep on going, so be careful. And again, if you're trading the American dollar on this, you need to watch gold, because, and I've done this, where I didn't like any of the setups on dollar Swiss or euro dollar or all the other dollar pairs. They were just going the wrong way. But for whatever reason, gold fit the bill. And the nice thing about gold is the spreads fluctuate a lot less. So it's another thing to keep in mind when you're trading news. Okay, I want to quickly take a look through a glossary of some of these terms that we talk about. Okay, monetary policy. What is you're going to hear this when you watch Bloomberg or CNBC or whatever. Monetary policy. What does that mean? Okay, basically monetary policy is anything the central bank does. Okay, when they're setting interest rates or they're doing quantitative easing or quantitative tightening, that is monetary policy. So when Jerome Powell talks about it, when Christine Lagarde talks about it, generally that's monetary policy. So the opposite of that, or the other side of that coin, is fiscal policy. And just give me 2 seconds here, please. And fiscal policy is things the government does. So if they increase taxes or decrease taxes or set price controls, that's fiscal policy. So there's actually a big difference, and there's two different sets of people that do that. For example, in the United States, fiscal policy may be set by Janet Yellen and Joe Biden and various others, whereas, of course, with monetary policy, those policies are set by Jerome Powell and Lael Brainerd and all the other guys in the FOMC. So you've got two different, and of course, they need to speak. You can bet that Janet Yellen and who used to have Jerome Powell's job, and Jerome Powell are speaking on a regular basis. She's the Treasury Secretary, by the way, and of course, Joe Biden will take advice from all those guys, but they will set policy based on different needs. Increasing taxes and decreasing taxes does certain things to the economy. Changing interest rates does something different to the economy. They all have the same goal. They want to release it. They want to decrease inflation. They want to balance the books, and they want to keep employment up. So it's a big juggling act between all these different players. And if a government and fiscal policy there's rumor about increasing taxes, that is actually good for a currency, because if the taxes go up, that makes the currency more valuable. If interest rates go up, that makes the currency more valuable. So you need to be paying attention to these things when you see currencies moving. Okay, another phrase that you're going to hear is called terminal rate. Well, what is that? And this is the situation right now where every investor in the world, and every hedge fund and every analyst, including myself, are wondering, where is the terminal rate for all these different central banks? And that is the highest rate of interest set by a central bank. Where are they going to stop? Because right now, you've been following the news, they're trying to fight inflation, they're increasing interest rates. And the US Fed have been doing it in big chunks at a time, 0.75%, which a few years ago was unheard of. You'd never hear of a central bank raising interest rates that dramatically. It's usually 0.25%, or in the case of Japan or Europe, 0.1%. I think the rate in Japan for one of their was minus 0.1, but now we're talking big chunks, 0.75. So the next interest rate rise in the United States may not be 0.75, it might be 0.5, because they're going to be slowing it down a bit. So the idea is, where is that terminal rate? Where are they going to stop? And they're debating now, is it going to be 5%? Is it going to be 5.5%? They don't know. And the Fed doesn't know either. They won't know until they see data on the CPI data on inflation, they see the employment figures and so forth. And Jerome Powell will say until he's blue in the face, he is data driven. He's not driven by politics. And that's something else you need to know about central banks. The concept of central banks is that they are completely non-political. They are detached completely from governments. Many presidents and leaders, global leaders, have tried to change that. The biggest problem we have right now is in Turkey with Erdogan and this very strange way they're setting their interest rates, or they're not. But generally speaking, the central banks are detached from government, and they are data driven. They're definitely not driven by politics, you hope. Of course, with fiscal policy, they're very much driven by politics. They need to be taking care of the people and getting elected in the next round. So you'll see that with a lot of fiscal policy decisions. Okay, the pivot point. We just spoke about the terminal rate. Well, the terminal rate is going to be driving, finding out where the pivot is. And the pivot is basically, when do the central banks change their mind? When is a current monetary policy not working? When do they need to reverse it? Well, classic example right now, we've had quantitative easing and interest rates being lowered for many, many years, to the point where interest rates were insanely low. And then suddenly we had a pandemic, we had energy crisis, we had Vladimir Putin, we had a bit of Donald Trump they're thrown in the beginning, and we have a massive problem with inflation. That was the pivot. In fact, many analysts who are still quite angry are saying the central banks took too long to get involved. They took too long to start raising interest rates, where what the central bank does not want to do is just go rushing in, fools rush in, and cause a recession. And again, this is a tricky bit for a central bank. They don't want to be lay off too much, because they need to fix the problem, but they don't want to go in like a bull in a china shop, as we say, and cause a massive recession. Unfortunately, the best way, and I'm going to go sideways a bit here, bad news for pretty much anybody, the best way that history has shown to fix inflation is to cause a recession, is basically to reset the economy. It's never pleasant. It means a lot of unemployment. It means a lot of businesses closing. And unfortunately, that may happen. And so they're predicting recession into 2023, and we in the business don't really see much of a way out of that. The good news is right now the American dollar is getting stronger, getting weaker, sorry, and the yen is getting stronger. So things are starting to normalize, but I'm not sure if we can avoid that recession. After a recession, we have emerging market debt, which is a big problem. And if the American dollar doesn't get too much, it doesn't get even weaker, it could be a big problem in 2024. So fingers crossed we don't have those problems, but sorry gang, it doesn't look good. Right. So getting back to the pivot, when a central bank has to reverse monetary policy. So we just spoke about the pivot that they had to make when they're trying to fight inflation. All the central banks either did it right or they were late to the game, whatever, and they're still desperately trying to control inflation with quantitative tightening and raising interest rates. So the question is now, when does it go back? When do we go back to lowering interest rates, and when do we go back to quantitative easing? Well, they don't know, and they won't know until they see the data. A lot of people are saying the end of 2023. I'm hoping it'll be more like the summer of 2023. Many economists and central bank governors are saying we're going to leave interest rates high for a while. We really want the economy to cool down a bit. We need to stop inflation. And what they're not saying is that we're going to have to cause a recession to do that. Hopefully it's not that bad, but okay. Right, the next thing on the glossary is the balance sheet. You're going to hear that a lot if you watch Bloomberg. Well, the balance sheet is basically how much stuff the central bank have in their closet. And here's a nice chart starting in 2007, and the banks just were buying and buying and buying, and then there was a big jump in 2019 when the central banks had to jump in, and hand on heart, the central bank saved us, and a lot of hedge funds and investors saved us after the pandemic. That pandemic really hit the stock market quite hard, but thanks to the central banks, stimulus and quantitative easing, and the resilience of investors, the economy was saved. After people didn't realize how close we came to a massive crash when the pandemic started. Luckily, that didn't happen. So you can see the top of that curve, that lovely blue line. It's curving at the top, and that represents quantitative tightening. they're unloading, they're unwinding their balance sheet. They're selling off the stuff they have in their closet. And that's what quantitative tightening is. And a lot of people have been complaining that the balance sheet is too big. Well, it's over, what, $9 trillion. That's a lot of stuff to have in your closet. Okay, that's about it. I think I've covered everything. If you have any questions, somebody asked a question here that I've missed. It says, do you have a favorite? I'm not sure what that. Okay, Tony, I'm going to, do I have a favorite news event? Do I have a favorite pair to trade? I actually don't. I mean, I'll be honest with you, and if you talk about a favorite pair to trade, I've found over the years that the markets are changing, have changed. I mean, I like to trade gold, but sometimes it's hard. When I first got involved in trading, I tried to avoid the Australian dollar because it just wasn't behaving the way I wanted it to. And then there was a period of time where I was actually trading for a Malaysian hedge fund, and I traded nothing but the Australian dollar. It just seemed to work. I try to avoid. I don't trade crypto. It's just not something I'm into. If you're doing it, then great, more power to you. If you're being successful, I try to stick to the basics: oil, the indices. I've done very well trading indices over the years. And again, got it, Tony. I understand the question now. Favorite economic calendar. Very good. Okay. That's a tricky one, and thanks for bringing that up. That's a very good point. Very often, and I hate to say this, the MetaQuotes calendar is wrong with their predictions and their forecasts. For me, the favorite calendar of all time is the Forex factory calendar. But I would highly encourage you to look at more than one calendar. There's the FX Street calendar that I contribute to FX Street every week, very often, more than several times a week. There's investing.com. Investopedia, there are tons of, I've got friends that are actually making calendars. It's incredible. You can find different news events are given different weights on different calendars. If you want to go to calendar, go to the Forex Factory calendar. It seems to be the best. And I had a friend of mine used to work there, and I said, why is this so good? And he says, because they have committee meetings. They actually sit down around a table and discuss every week the impact of different calendars. If you click on the calendar events as well, they give you a lot of details as to what the event is all about. I misread the question. I'm going to answer it as I may have. If I have a favorite calendar event, I actually don't. A lot of traders will not trade the non-farm payrolls. I've traded non-farm payrolls very often, but the thing about that is the markets can become so illiquid that it can throw you off, or it can do it, pardon my finger, it can do a wonderful V pattern like this, and you can catch trades up and down. It seems to be different every week, or sorry, every month. One of the events I used to trade very often, and I should do it again, is the New Zealand Dairy Farm Report. It sounds very odd, but in New Zealand, dairy is a huge, huge industry. And the New Zealand Dairy Farm Report for months on end was always wrong. The forecast was always wrong. And I found it was easy to trade. So you might want to try that. Again, during the pandemic, things like CPI and retail sales, they didn't even move the markets. You're trading news events based on vaccines. That was the way things went during the pandemic. Now we're getting back into normalcy. The thing that moves the markets now is CPI data, because right now, as I said many times, the central banks are fighting inflation. So CPI is critical. It could be a few years ago, CPI didn't even move the needle. So you need to be watching the markets and seeing what's going on the planet. And again, the US Federal Reserve are trying to gauge what the economy is all about right now. So almost everything, retail sales, consumer confidence, GDP, with any economy is driving the market. So we're getting back to normal as to what's making the news. And I cannot tell you enough, let the fundamental events drive the markets against the trend, get into the trade on the technicals, and you'll have a happy life. One thing to be aware of, though, if the fundamentals are way out of whack, like let's say, for example, Canadian retail sales are predicted to be 3%, and it comes out at 6%, well, it's way more than analyst expectations, and that could drive the Canadian dollar well past any technical level. So you need to be able to judge. So if the predicted level was 3%, and it came out at 3.5% or 3.2%, it'll go in the right direction and it'll probably hit a technical level and you can trade it and have get some pips. If it's way out of whack, you need to be careful that price action doesn't go way past your technical level and carries on in the wrong direction for several days. That has happened. So you need to be aware of those levels and what the news is, the actual news has come out. Let me see if there are any more questions here. No, not right now. Okay, well, if you have any questions, just drop us an email, jump on the Valutrades chat line. Yeah, and Tony, I'm actually not Graham. Unfortunately, it says Graham below my screenshot. My name is Brad Alexander, but you can call me Graham if you like, no problem. Anyway, hope that made sense. And again, some people find fundamental analysis and talk about central banks quite boring. And I'm going to repeat, if you want to be a successful retail or professional trader, you need to be able to understand what Jerome and Christine are talking about. Anyway, we'll see you next time, and thanks a lot. Take care.